Welcome to the debate. We are diving deep today into the recent financial disclosures from Oracle Corporation. Specifically, we're looking at this tension created by their, remarkably aggressive and I'd say extremely capital-intensive push into cloud infrastructure.
Indeed. And that 10Q filing for the quarter ending August 31st, 2025, it really forces us to confront the high-stakes nature of this whole corporate transformation. We're looking at a company making maybe an existential pivot, and the financial metrics coming out of it are, they're fascinating, yes, but I'd argue they're also deeply alarming, at least in the short term.
Right. So the central question, I think, for investors, for analysts today has to be, does this massive increase in capital expenditures, the necessary infrastructure build-out, which has, let's be clear, temporarily wiped out the company's traditional free cash flow position, does this represent a sustainable and strategically essential acceleration of their Oracle Cloud strategy? Now, I firmly argue that the underlying metrics, particularly the stunning growth in committed customer contracts, they confirm a successful high-growth path. This is simply the cost of securing dominance.
Okay, I come at it from a slightly different angle. While, look, no one's denying the shift toward cloud revenues is happening, the sheer scale of the capital deployment and the immediate negative resulting impact on crucial liquidity metrics, that introduces serious, potentially unsustainable financial strain and, frankly, elevated risk. The price tag for this expansion, you just can't isolate it from the overall health of the balance sheet.
Okay, so let's maybe lay out the foundation for why this investment is necessary in the first place. The financial shift we're seeing, it really reflects a decisive managerial choice, a choice to secure future market dominance. These investments are being driven directly by, verifiable customer demand. Cloud revenues now make up 48% of total revenues. That's a substantial jump from 42% just a year ago. And if you look specifically at cloud infrastructure OCI revenue growth, it contributed 77% of the constant currency growth in total cloud revenues. I mean, that segment is just exploding.
That's a compelling point about the cloud growth. I'll grant you that. But, growth at any cost is rarely sustainable in the long run.
But it's costing what is absolutely necessary to capture guaranteed future revenue. And that guaranteed, it's quantified right there in what I think is the most powerful figure from this entire filing: remaining performance obligations, or RPO. This figure jumped from $99.1 billion to an incredible $455.3 billion as of August 31st, 2025. That's a five-fold increase in secured long-term customer commitments. So the required CapEx surge, it's simply the logistical function of building out the data center capacity, deploying the hardware needed to service this, nearly $500 billion pipeline over the next few years. You just can't capture $455 billion in guaranteed revenue without the infrastructure ready to back it up.
That is an extraordinary figure, I agree, and I grant you the RPO validates customer interest, absolutely. But we still have to address the immediate financial disruption that's being introduced by chasing that pipeline. We're looking at an acceleration of CapEx, so sudden, so massive, it's actually destabilized key liquidity metrics. Net cash used for investing activities increased by a staggering $6.0 billion just for the quarter. Why? Because capital expenditures alone soared from about $2.3 billion in the prior period to $8.5 billion this quarter. This isn't just investment, this is a radical shift in capital deployment strategy.
And that rapid deployment is, as I said, a deliberate decision. It's about capturing market share while the window is open.
But the impact on working capital and liquidity is frankly alarming. The working capital deficit, current liabilities exceeding current assets, it widened from around $8 billion to a really concerning $15.2 billion. They're sinking nearly twice as far into the red just to manage the short-term financing needs of this expansion. And this strain, it's compounded by the future obligations that are looming large. The company disclosed $99.8 billion, almost $100 billion, in additional operating lease commitments for data centers. These are expected to kick in between fiscal 2026 and 2028. That's immense, long-term, high-cost leverage that hasn't even technically hit the balance sheet yet.
Okay, let's deeper at the cost structure, though, because I think you're framing what is really essential investment as if it's purely financial distress. This enormous capital expenditure, the $8.5 billion spend, it's foundational. It's designed specifically to scale the OCI offering, which, let's face it, is clearly succeeding with 55% constant currency revenue growth. I understand why you characterize it as pressure, but I'd argue this is more like a necessary prepayment on future infrastructure capacity. This expense is strategic and likely non-recurring at this specific, sort of hyper-accelerated scale relative to the immediate capacity build-out required right now.
Well, I agree that some CapEx is necessary, obviously, but the sheer overall cost structure is complex and I think worrisome. The CapEx, you could say that's just the construction crew showing up. But the operating costs are the monthly utility bill, and that's also soaring. Cloud and software operating expenses jumped by $1 billion. That's a 41% increase in constant currency. In this surge, it's specifically attributed to higher infrastructure expenses, so think energy, maintenance, networking, and the employee-related costs needed to staff and support this vast new cloud environment. So what we have is an explosive, simultaneous surge in both the upfront CapEx and the immediate ongoing operational expenses required to actually run the cloud.
But that dual surge is, well, it's the inevitable outcome of scaling a successful business segment, isn't it? You build the data center, then of course you have to power it and staff it. That follows.
Sure, but then we also have to talk about the internal inefficiencies this high-stakes transformation seems to be exposing. Why, right in the middle of this massive infrastructure investment, is management also initiating a major organizational overhaul? The company recorded $402 million this quarter alone as part of this new $1.6 billion fiscal 2026 restructuring plan. I mean, if the cloud strategy is so successful and robust, why do they suddenly need to spend $1.6 billion on restructuring? It kind of suggests that the rush to cloud has maybe revealed some fundamental embedded operating inefficiencies, or perhaps a misalignment of resources that now needs to be surgically corrected and expensed right in the near term.
I see the restructuring rather differently. I view that $1.6 billion expense not as some admission of failure, but actually as a commitment to strategic realignment. They're likely shedding legacy operational costs and focusing resources squarely on cloud engineering and development. That $402 million we saw this quarter, that's an expense today that's meant to create a leaner, more efficient structure, one capable of sustaining the high-margin cloud business tomorrow. It looks like they're clearing the organizational deck, so to speak, to handle the demands of that huge $455 billion RPO. This is about disciplined execution, I think, not underlying chaos.
Okay, but that brings us right back to the core issue of immediate liquidity and why that free cash flow reversal is just so problematic. You can rationalize the investment, sure, but you can't just ignore the immediate impact on cash. FCF, it's the standard measure of financial flexibility, right? Cash left over after maintaining and expanding the business. The trailing 4 quarters FCF plummeted from a positive $11.3 billion, roughly, to a negative $5.9 billion. And maybe even more telling, FCF as a percentage of net income fell from 103% down to negative 47%. This is really the critical indicator here. It means that despite strong revenues and operating profits, the company is currently consuming capital at, frankly, an alarming rate, faster than its operations are generating it.
I'm sorry, but I just don't buy that the FCF metric, especially when you apply it in a standard trailing 4-quarter way, is the right tool to judge financial health during a period of such hyper-accelerated infrastructure deployment. It feels like we're penalizing the long-term growth story by using a narrow, immediate FCF metric. Remember, the definition of FCF is net cash from operating activities minus capital expenditures. So let's look at the operational health itself. Net cash provided by operating activities actually increased by 10% this quarter, hitting $8.14 billion. The core business is still robustly cash generative.
Okay, the core operations are healthy, yes, but that operating cash flow, the $8.14 billion, it's simply not enough to cover the massive CapEx bill of $8.5 billion. Just looking at those two numbers for the quarter, they're running a deficit of nearly $500 million this quarter alone on that specific reconciliation. This means they're having to rely on existing cash reserves or potentially external financing, maybe some non-operating sources, just to cover that gap. And that forces a conversation about capital strain. How long can they actually sustain this kind of capital consumption without hitting some kind of limit?
They can sustain it precisely because the CapEx is, I believe, a manageable, temporary investment activity. It's specifically designed to secure that $455 billion pipeline. We really must view the $8.5 billion CapEx as a massive prepayment. Imagine, pre-selling $500 billion worth of product. You'd naturally expect a huge immediate spike in the required investment to deliver. They seem to be making a managerial choice to accelerate that investment now to lock in the long-term, high-margin subscription revenue. It looks like a deliberate strategy, front-load the cost and de-risk future delivery.
Well, let's turn our attention then to the overall leverage picture and especially those massive off-balance sheet commitments, which I think dramatically amplify the financial risk profile that the negative FCF signal is already flashing. The company carries substantial existing debt, right? Non-current notes payable and other borrowings total about $82.2 billion. That led to $923 million in interest expense just this quarter. Okay, now we layer on top of that the $99.8 billion in future operating lease commitments for data centers.
And those commitments, again, they secure the capacity required for the RPO. They're linked.
They are linked, yes, but they are still contractual obligations that represent immense off-balance sheet leverage. Well, okay, they're accounted for as operating leases and not technically debt under current GAAP rules. Any sophisticated analyst has got to factor that nearly $100 billion into the overall financial risk assessment. When you look at traditional leverage ratios like debt to EBITDA, for instance, that kind of lease liability profoundly changes the equation. It could potentially limit future debt capacity or maybe increase the cost of future borrowing if this whole transformation doesn't execute, perfectly.
That's a fair point about the analytical need to incorporate future obligations. I'll concede that. However, looking at the balance sheet, the management of existing debt actually appears pretty controlled. They did execute scheduled repayments, reducing non-current notes payable slightly this quarter. And perhaps more critically, we have to look at the immediate and, importantly, non-debt liquidity that's provided by customer prepayments, what we call deferred revenues. Current deferred revenues, so cash received but not yet earned, jumped significantly. They went up to $12.1 billion from about $9.4 billion in the previous quarter. That's a $2.7 billion increase in immediate non-debt liquidity. That acts as a pretty crucial buffer, doesn't it? It helps de-risk the existing leverage profile and provides certainty for near-term operations.
Deferred revenue is excellent. Absolutely always good to have, but typically it covers operating cash needs, maybe smooths things out. It doesn't really fund massive capital investment needs of this scale. So the sheer scale of the investment risk, I think, remains. And you mentioned management's confidence. Yes, they did increase the quarterly cash dividend to 50 cents per share. Now, that is a highly visible sign of confidence, certainly, but it's also an ongoing cash commitment that competes directly with the need to fund this massive CapEx deficit we've been talking about. So are they signaling confidence, or are they perhaps prioritizing shareholder returns over immediate cash preservation at a time when they're technically burning cash just to cover infrastructure? It's a question worth asking.
I think they're signaling confidence that the RPO pipeline, that $455 billion figure, is strong enough and visible enough to comfortably fund both the necessary investment and shareholder returns over time. That RPO figure, it really dwarfs the total long-term liabilities currently on the balance sheet. This aggressive CapEx phase, yes, it's costly, but it looks like a temporary acceleration, one fueled by guaranteed customer demand. It's a calculated move, maybe high stakes, sure, but the data supporting the potential payoff is, I'd say, overwhelmingly positive.
It's calculated perhaps, but the complexity here, the soaring OPEX, the $1.6 billion restructuring cost alongside the growth, the negative FCF, and those looming future liabilities, it means that the risk of misstep is incredibly high. Perfect execution is never guaranteed, is it? And the financial structure, right now, is clearly absorbing enormous strain.
Okay, so to summarize my position, the data, I think, overwhelmingly confirms that Oracle is executing a bold and so far successful pivot, one that fundamentally restructures its business around cloud subscription revenue. That five-fold increase in remaining performance obligations, it validates the accelerated CapEx investment we've seen. And while, yes, we observe a short-term negative free cash flow, this is largely a mathematical result of a massive planned investment cycle. It's not, I believe, an indicator of fundamental operational weakness, especially given the 10% increase we saw in core operating cash flow. This strategy, it seems to be securing highly lucrative future revenue streams, confirming a strong path forward.
And conversely, my view is that the immediate financial data highlights significant, quantifiable risk that needs careful watching. The reversal to negative free cash flow, combined with that rapidly expanding working capital deficit, those are clear indicators of immediate financial pressure and liquidity risk. This short-term strain, coupled with the commitment to absorb massive restructuring expenses and the need to fund nearly $100 billion in future off-balance sheet lease obligations, well, it requires a deeply cautious stance, I feel. The immense financial cost of this transformation really must be prioritized in any valuation assessment right now.
Yeah, I think the source material we've discussed today clearly illustrates the high stakes involved in this accelerated transformation. It provides really compelling data points that, support both an optimistic view of future growth potential, but also a necessary cautionary stance regarding these immediate financial pressures and the rate of capital consumption.
It really is a phenomenal case study in transformation finance, isn't it?
There's certainly much more to explore here, particularly in how management navigates this critical liquidity crunch in the coming quarters, while still honoring those massive future commitments needed to keep up with the demands of their huge $455 billion revenue pipeline.